Why are US dollars appreciating? Now, I don't mean to bring this topic up to talk about, like the five major factors that are bringing US dollars higher from like a macro standpoint of, well, this influence, this president did this or this, whatever. I want to just get down to the nitty gritty of price action, whereby like inflation does X, US dollars do Y, and interest rates do Z, because we have some funkiness here. And if you read a textbook or you read a paper by a macro economist or what have you, you'd be quite confused, Mikey. And this is what you were asking me about yesterday, because we have the highest inflation here in the US in over 40 years. Here's a nice chart of CPI, biggest print this week that we've had since 1981. And inflation, as far as textbooks are concerned, bad for your currency, right? And this is what you were asking me about yesterday.
Yeah, it seems like a really strange contradiction. And I took all the intro econ classes in college, and you would think a high inflation value is devaluing your purchasing power. It should make your currency strength actually weaken. And now we're seeing the highest we've seen in decades. And at the same time, this contradiction where the US dollar is trading at highs we haven't seen in multiple years. So it's kind of like, well, what are we actually doing here? How can we explain the situation? And how can we, more importantly, trade this situation?
Exactly right. Because before we even get into that US dollar, I want to back up just for a second, because this CPI, inflation, whatever, all these different terms, PPI, there's also that, the producer's price index, whatever you want to call it. Inflation being on the rise, being the highest it's been since the 80s, Mikey, is just telling you prices for goods and services are the highest that they've ever been. And you would expect that to coincide with, oh, well, if we had burritos for lunch, if burritos right now are the most US dollars that they've ever been, then I would expect the purchasing power of US dollar to be lower. It's kind of like evening out. Inflation's on the rise. These prices are increasing. And so the amount of dollars I have in my pocket must be worth less, because they'd be raising those prices to counteract the fact that the dollars they're getting in the door are worth less. And it's in a vacuum, that's the way things go. That's the way these two big arrows go. We're not in a vacuum. We're in an open market, and US dollar is at 20-year highs this week, the same week, Mikey, that inflation is printing a 40-year high. US dollars are printing a 20-year high. And this doesn't make sense unless I bring in another character, which is interest rates. This is the missing piece that describes all of the awkwardness in inflation versus Forex. And US rates are also on the rise. And they actually, you look at that red line, that's the 2-year US Treasury rate. They were on the rise before US dollars. And so here's where you start to rope in the nuance. You've got a stronger US interest rate environment, Mikey, and you start to think to yourself, well, if inflation's at 40-year highs in the US, and it's also very high in Europe, it's also very high in Asia, it's not just specific to the US, then someone's got to lose at some point, right? Like all currencies can't go down at the same time. And so that starts to paint the picture a little bit. Before even getting there, I do want to illuminate this relationship here, which is inflation versus interest rates. Actually, why don't you talk a little bit about this, how inflation pushes central banks who then push interest rates?
Sure. So the Federal Reserve in the United States here has what's called a dual mandate. They have two things they're supposed to focus on. Their role in the structure of markets is to have stable prices and maximum employment. Stable prices would mean manageable inflation. Normally, we would say 2% inflation is normal. One of the tools they use to control inflation and maximize employment is to adjust their short-term interest rate, their federal funds rate, which is a direct relationship to 2-year interest rates. So when they see inflation numbers printing higher, what they will do is they will raise their interest rate. basically the premise is in classical economics and school of thought is that with high interest rates, people will save money. They will invest. That reduces the supply of currency in the market and hopefully stabilizes inflation, kind of gets it under control. But it also means that high interest rates are attractive to international investors. And those people who want to capitalize on the high yields of US Treasury debt convert their currency to US dollars, which increases demand for dollars. And therefore, you have a high interest rate environment and a high foreign exchange market, or a strong US dollar.
Nailed it. Absolutely right. The two biggest opponents of the Fed or any central bank are inflation and recession. And so when they're fighting inflation, Mikey, they're looking at hiking rates because just like you said, they want people to stop spending so much money. They don't want money to keep changing hands so much, hiking prices of, energies and food and everything else. But when the market is not doing well, which it is kind of right now, they want to fight recession and bring those rates lower. So we're actually stuck in this weird middle ground where the Fed is hiking, but they don't know if they want to hike too much to cause a recession in there. And you have the Eurozone at zero because they're kind of feeling the same thing. Like, I don't think we can hike right now, even though there's inflation, because our economy is not strong enough. Japan, even worse. They're actually still negative because their economy not strong enough, they feel, to start hiking rates. England doing pretty well, but not as good as the US. And so you remember that this Forex game is one of relativity. They can't all depreciate. It can't just be inflation is up across the board. US dollars and euros and pounds and yen, everything's getting crushed. All of those currencies, yen, pound, and euro, getting crushed at the exposure of the US dollar. Somebody has to be the flight to quality, and it is the US right now. We've got the highest rates of the major economies. We are the most stable right now of the major economies. And that's how you have rising inflation and rising US currency prices. Pretty good. What do you think?
Yeah, really great stuff. And we're tied in a little bit of economic theory without going too deep. But if you do have questions, you can always reach out to us on Twitter or on email. I'm Mikey G, and he's Frank_Caberna. And we also talked about like some potential trade ideas on this at the beginning of the show. So I think we nailed it, man.
Yeah, great stuff here on Friday afternoon. And yeah, it's if you don't think it's tradable, the question then becomes, where do you think rates are going? They're right now at an impasse. Do they keep going higher to fight inflation, or are they going to go lower now to fight recession? So some cool trades ahead. Mikey, thanks so much for joining me. Yeah, go follow Mikey G on Twitter and ask us any questions about Forex or anything else. Hopefully this was a fun one, but stay tuned for Splash in the Futures coming up next. Have a great weekend, everybody. Peace.